Good morning and welcome. You're
Yeah.
listening to The Deep Dive, and this is our Bulls, Bears, and the Bell weekend edition. And wow, what a week. If you felt like you were trying to steer a ship through, I don't know, a hurricane maybe, swinging from fear to just pure euphoria and then right back again,
Yeah.
well, you were definitely not alone.
Oh, absolutely. It was relentless volatility, just stomach-churning stuff.
Yeah.
We saw what traders often call a complete round trip. You know, those steep, painful losses we got hit with the week before from the tariff sell-off, all gone, completely erased by Friday's close. It was fast. It was powerful.
A massive reversal.
But, and this is the key thing, the real story here, is that the market's doing all this under this, thick cloud of extreme uncertainty. It makes it incredibly sensitive to any shift in the story, the narrative.
Okay, so that sets up our mission for today, doesn't it?
Yeah.
We need to unpack what exactly was driving this, well, this Jekyll and Hyde behavior for the week ending October 17th.
Right.
And maybe more importantly, we need to get you ready for next week, October 20th through the 24th. Because it really feels like we're hitting a major inflection point, maybe one of the biggest this year.
I think that's fair. Look, the market right now is basically being pulled in two totally different directions by these huge non-economic forces.
Okay.
On one side, you've got all the geopolitical noise, the constant stream of trade talk, shifting rhetoric, often, coming straight from social media, very unpredictable.
Tweets moving markets, again.
Exactly. And then on the other side, you've got this ongoing U.S. government shutdown, and that's created this really severe, persistent data vacuum. We're missing key info.
Right. So it really feels like investors are being asked to, I don't know, fly blind while battling these hurricane-force geopolitical winds.
That's a good way to put it.
And all of this is happening just as Q3 earnings season really starts to ramp up.
Yeah.
The market just doesn't seem to have a fundamental anchor right now.
It doesn't.
So, okay, let's unpack this. How do we even begin to make sense of such a deeply conflicted week?
Well, I think you have to start with Monday, October 13th. Because the market pulled off this really remarkable recovery. It just showed how fragile that negative sentiment, that short interest really was.
Right, because the previous Friday had closed way down, painfully down.
Deep in the hole, yeah. And the reversal was just instantaneous. It wasn't driven by fundamentals. It was pure geopolitical hope, really.
And the trigger wasn't some big economic policy change or a central bank stepping in.
No.
It was, what, a single social media post?
You got it. A post from President Trump. It seemed to soften his tone on China just a little bit.
Huh.
And that single development, just that hint that maybe the trade dispute was de-escalating, maybe the worst-case tariff scenario wasn't happening, that was enough. Enough for investors to basically say, okay, panic over and pile back in, reclaiming all of Friday's losses almost immediately.
And the numbers certainly showed that rush. The Dow jumped, what, 1.29%?
The S&P 500 up 1.6%, and the NASDAQ, the tech index, it really led the charge, up 2.2%.
That initial burst, it suggests investors were just desperate for any good news, didn't it? Didn't really matter where it came from.
Desperate is definitely the right word. But, that optimism, it was paper thin. By the middle of the week, that excitement just evaporated. It faded pretty quickly into these pervasive jitters.
The trade worries came back.
They resurfaced, yeah. Reminded everyone that fundamentally nothing had actually been solved yet. And you saw it hit the high growth areas, especially semiconductor stocks. They got hit hard. So the S&P 500 and the NASDAQ, they retreated significantly on Tuesday. The Dow actually managed a small gain, but that split, that divergence, it showed that the underlying trade concerns, they were just masked by Monday's rally, not gone.
Okay, so trade jitters simmer down a tiny bit, and then boom, we get a major domestic shock. The real nail-biting moment came on Thursday, right?
Yeah.
Centered on regional banks here at home.
Yeah, this wasn't about China tariffs anymore. This was about balance sheets. It was a genuine credit scare.
And it started with something that seemed kind of small initially.
Right. It looked isolated. Two firms that serve the auto industry filed for bankruptcy. Happens all the time in cyclical sectors. But then the details started coming out, and it was, well, unsettling.
Because
Zion's Bank Corporation, that's Zion and Western Alliance Bank Corporation Wall, two pretty significant regional banks. They both confirmed they had material exposure to fraudulent loans tied to those bankruptcies.
Oof. Okay, yeah. When you hear the word fraud, especially tied to loans and underwriting, the market instantly shifts gears, doesn't it? It goes from worrying about, growth slowing down to worrying about systemic risk.
Exactly.
What was the specific issue that caused Zion and Wall to just plummet, double-digit declines?
Cheap declines, yeah. The specific worry was around their C&I portfolios, commercial and industrial loans. And the fraud suggested, well, potentially a serious breakdown in their underwriting standards. Maybe internal controls weren't catching things.
Right.
And for the broader market, the fear was contagion immediately. If Zions and Western Alliance somehow missed fraudulent activity on their books, well, who else might have similar hidden risks lurking?
So it wasn't just the dollar amount. Those Zions eventually took a, what, $50 million charge-off?
$50 million reported, yeah. But you're right, it wasn't just the money, it was the qualitative fear. Is the whole regional banking system sitting on some unforeseen problems? Maybe similar to the wobbles we saw earlier in the year with some other banks.
That systemic fear explains why the whole sector dropped so hard.
Precisely. Regional bank shares collectively fell by a dramatic 6% on Thursday. And the selling was broad, it was indiscriminate, it was the market basically asking, is this just a Zions problem, maybe bad management there? Or is this proof that underwriting quality got sloppy everywhere during that recent loan boom? It was a serious gut check on confidence.
Okay, so after all that chaos, the initial high, the trade worries coming back, the credit scare somehow, we managed that Friday save you mentioned. We completed the round trip. What happened? What factors came together to let the market end the week on such a high note?
It was really two specific things, perfectly timed. First, several other major regional banks reported their earnings, and guess what? They were solid.
Okay.
They showed healthier balance sheets, better underwriting results than what Zion's specific issue implied. That helped calm those acute credit fears almost instantly.
Okay, that makes sense. And the second thing?
Geopolitics turned helpful again. News came out that Treasury Secretary Scott Bessent was scheduled to actually talk with his Chinese counterpart. Just that small step, that little bit of movement towards dialogue, it was enough. Enough to kind of push aside the pessimism from earlier in the week.
And that convergence gave us pretty strong weekly gains, despite all the craziness. The Dow finished up 1.6%, right? Added over 700 points.
711 points, yeah. S&P 500 added 1.7%. NASDAQ gained 2.1%. And interestingly, the Russell 2000, the small cap index, which often reflects more domestic and regional health, it actually led the rally, up 2.4% for the week.
So it's just crystal clear this market is being pushed around by sentiment, by headline sensitivity. But that raises the bigger question, doesn't it? Why is sentiment so dominant right now? What's making the market so jumpy?
That sensitivity, that jumpiness you mentioned, that's absolutely key to understanding what's going on. You called it a conditioned, almost Pavlovian response to the U.S.-China headlines.
Yeah, it feels like it. A tariff threat tanks the market one day.
Yeah.
A slightly nicer tweet sends it soaring the next.
Exactly. And the core reason, the fundamental reason the market is so susceptible to just trading headlines is this gaping data vacuum we talked about.
Right. In a normal, rational market, you weigh headlines against the actual economic numbers, GDP, inflation prints, jobs data. But those numbers, they're just not there right now.
Precisely. When you remove that hard, objective economic data, it creates this void. And what rushes in to fill that void? Speculation, fear, hope, narrative. When investors don't have that fundamental anchor, they just overreact, sometimes wildly, to the only information they do have, which is often just political rhetoric or hints of policy shifts.
And that void, that data vacuum, is a direct consequence of the U.S. government shutdown moving into its second week. Which specific reports are we missing that are causing the most heartburn?
We're missing the September numbers for several absolutely critical metrics. The big ones are the Consumer Price Index, CPI, that's our main inflation gauge.
Right.
The Producer Price Index, PPI, that tracks costs for businesses. And the key retail sales figures, which tell us about consumer spending. These aren't just nice-to-haves. They're, the lifeblood for forecasting. Without them, investors, companies trying to plan, and crucially, the Federal Reserve.
Yeah.
Everyone's operating with impaired visibility. It's like driving in fog.
So if the official stats aren't coming out, how are these big market players, the sophisticated investors, making huge decisions? What are they actually looking at?
They're forced to rely on what you might call alternative indicators, things like the industrial production data, which the Fed itself compiles, and the regional manufacturing surveys, from the New York Fed, the Philly Fed. Those give some clues.
But they're not the whole picture.
Not even close. They're useful, definitely, but they mainly cover manufacturing, factory output. They don't really capture the huge services side of the economy nearly as well as the national reports like CPI or retail sales do. So the data they do have is incomplete. It creates significant estimation risk. You're guessing more than you normally would.
And this sounds like it just creates confusion, especially around policy. Tell us about this feedback loop that the ambiguity has created, particularly between what the Fed says and how the market prices things.
Okay, yeah, here's where it gets really interesting. The lack of hard data. It has massively amplified the power of Fed commentary. Normally, right, you hear a Fed official speak, and you interpret their comments alongside the existing inflation data, the jobs numbers, you have context. But in this environment, when there's no fresh CPI report to challenge or confirm what they're hinting at, well, dovish remarks from Fed officials carry this immense, almost disproportionate weight.
Can you give us an example from this past week?
Absolutely. Fed Chair Jerome Powell made a comment, suggested that more rate cuts were possible. Now, normally that's just one line in a broader speech, maybe balanced by other comments. But because the market had zero current inflation data to push back against that narrative, his suggestion was immediately taken as gospel. It got translated into a concrete expectation. Easing is coming. And that fueled a lot of the bullish sentiment we saw, especially in stocks, because investors started pricing in cheaper borrowing costs, maybe sooner than they otherwise would have.
So the market isn't just listening to the Fed. It's almost using the Fed's dovish tone instead of the economic reality it can't see.
That is precisely the dynamic, and it's a dangerous one. The market is now pricing in policy easing, assuming rate cuts are coming, based almost entirely on the assumption that the delayed economic data, whenever we finally get it, is going to be soft, that it will justify those cuts.
And that sets up a huge potential problem down the road.
A colossal one, because if that delayed CPI report, the one we're all waiting for next week, if it contradicts that expectation, if it comes in hotter than everyone assumes, well, the market repricing won't be gentle or gradual.
No.
It'll be exceptionally rapid and sharp because you've got maybe 2 weeks worth of bullish assumptions baked into current prices that suddenly look wrong. They'll have to be unwound potentially in a single session. Big risk there.
And meanwhile, the only real fundamental insight we are getting is from the early earnings reports. We saw mixed signals from the big banks already, right? Jamie Dimon at JP Morgan sounding pretty cautious about the global picture.
Very cautious.
But then Wells Fargo actually beat expectations. So it's this battle between individual company results and this huge macro-level policy vacuum.
It is. And those micro reports, those earnings, they're providing the only tangible, fundamental data points we really have to grab onto right now. But even those are impacted. Companies are telling us they're struggling to give clear forward guidance because they don't know what inflation or consumer demand really looks like nationally without the official government numbers. The fog of war, as they say, is thick for everyone.
Okay, so to really get the full picture of the market's mindset last week, we need to look beyond just stocks, right? Let's shift focus. How did other assets react? Volatility, bonds, commodities, even crypto. Because their movements often tell a deeper story about risk appetite, especially when you have these conflicting signals from geopolitics and the data blackout.
Yeah, absolutely. Sometimes the action in these, let's call them peripheral assets, reveals the underlying stress that a headline equity rally might be masking.
So let's start with the VIX, the SIBO Volatility Index, the fear gauge. It must have had a wild ride, too, reflecting that sentiment whiplash.
Oh, it was a perfect barometer of the week's stress. Remember, it had already surged above 21 the week before on those tariff threats, and it bounced around violently all week long, confirming just how intense those mood swings were. But the really key signal, and this ties back to that Friday save, was the VIX's sharp reversal on Friday.
Okay.
It actually touched an intraday high of nearly 29 that morning. Now, 29 on the VIX, that suggests some real acute, almost panic-level fear was still bubbling under the surface.
Right.
But by the close, it settled sharply back down, finishing below 24.
Wow, like a 5-point drop from the peak of fear in just a few hours.
Yeah.
That tells you something, doesn't it? That fear, while definitely present, got overridden pretty quickly by buyers stepping in, maybe technical levels holding.
Exactly. It suggests maybe a near-term floor is established, that the panic didn't spiral.
Okay, what about bonds, fixed income? You said Treasury yields stayed in a tight range. That seems odd with all the volatility elsewhere.
It does seem odd, but it reflects that tug-of-war we talked about. On one hand, you had real flight-to-safety demand. People were buying treasuries because of the trade fears, the credit scare with the banks. That pushes yields down. But on the other hand, you still have underlying inflation worries and massive government debt issuance, which normally push yields up.
So they were just stuck in the middle. But the dominant force seemed to be the hope for a dovish Fed.
That expectation, combined with that flight to safety bid, basically anchored the yields. The really critical level everyone was watching was 4.0% on the 10-year Treasury yield. That's a big psychological number.
Right.
It hovered right around there all week and actually finished just a tiny bit lower, down about 5 basis points for the week to 4.001%. The fact that it held above or right at that critical 4% mark tells you the market still believes economic momentum is slowing down and that eventually the Fed will have to cut rates. Caution, but not collapse.
Okay, let's look at tangible stuff. Physical assets, gold, usually the go-to hedge against instability. How did it do?
Gold did exactly what you'd expect it to do in a period with high geopolitical risk and these worries about government shutdowns and fiscal health. It surged early in the week.
How high?
To a record high, actually. $4,125 per ounce.
Wow, record high.
Yeah, and that speaks volumes, doesn't it? Even while the stock market managed to rally back, the gold market was screaming persistent underlying anxiety. It was acting as a hedge against both a potential trade war flare-up and the longer-term worries about government borrowing and the uncertainty from the shutdown.
But in stark contrast, oil told a very different story, right? A less optimistic one about global commerce.
Very different. West Texas Intermediate Crude, WTI, it stayed soft. It was trading persistently below $62 a barrel.
Yeah.
And that's significant because oil prices are often seen as a direct reflection of expectations for global demand. So while maybe U.S. consumer sentiment seems okay for now, the weakness in oil suggests there's deep skepticism out there about industrial demand, about manufacturing health, not just here, but across the whole global economy. That split between gold soaring on fear and oil slumping on demand worries, that's a major cross-asset conflict playing out.
Okay, one more. Digital assets. Crypto, often called the ultimate high beta proxy for pure speculative risk appetite. How did that world react to all these global shocks?
Yeah, crypto mirrored the broader market's wild swings, but as usual, with extreme leverage and volatility. Remember that tariff news from the previous weekend?
Yeah.
It triggered a massive liquidation event in crypto derivatives. Something like $19 billion worth of leveraged positions got forcibly closed out. Yeah. These kinds of events just show how much speculative capital is built up in that asset class. Bitcoin, which is sort of the main benchmark, it dropped hard from a near $126,000 down below $115,000. And then it spent the rest of this week just trying to stabilize, sort of like the stock market. It really shows that even these supposedly decentralized assets are still tightly linked to global risk-on, risk-off sentiment.
Okay, so we've painted the picture of last week's chaos. Now let's pivot and look ahead, because this coming week, October 20th to 24th, it feels really decisive. The market's focus seems to be shifting dramatically, doesn't it? Moving away from speculating on headlines and tweets and towards digging into the micro-level details of corporate fundamentals as earnings season really kicks into high gear.
That shift is definitely happening, and it's created this really interesting tension. If you look at short-term analyst sentiment right now, it's sort of coalesced around a moderately bullish view. But here's the catch. That outlook seems to be based almost entirely on the market's technical resilience, how it bounced back, and sentiment getting less frothy, not necessarily on deep underlying fundamental strength.
Okay, let's break down those reasons for the moderately bullish technical view. What specific defenses did the market put up last week that are making technicians feel a bit better?
Well, first, there's that VIX reversal we just talked about, the fear gauge backing off sharply from its peak. That tells you the acute panic subsided and near-term momentum shifted back towards buyers, kind of quelling the immediate selling pressure.
Right.
Second, and this is technically really critical, the S&P 500 successfully defended its 50-day simple moving average, the SMA. That level is right around 6,550.
And why is that 50-day SMA considered such an important line in the sand for traders?
It's just widely watched as a key marker for the short to intermediate term trend. A lot of trend-following algorithms and technical traders use it. When a major index breaks decisively below the 50-day, it often signals that the recent upward momentum is broken and it can trigger more technical selling. So the fact that the S&P bounced off 6,550 and held it, that tells those technical players that the primary intermediate uptrend is, for now at least, still intact. If it had failed there, we likely would have seen a much deeper correction, probably testing the longer-term 200-day moving average next.
Okay, so VIX down, 50-day held. What else looked like stabilization?
Third, you had the 10-year Treasury yield, holding that psychologically key 4.00% level that eased the most extreme fears of a severe growth collapse or some kind of financial accident. The bond market is signaling caution, definitely, but not outright panic.
Got it.
And fourth, kind of interestingly, we saw what looked like a healthy reset in some of the most speculative corners of the market. Think about those really frothy quantum computing stocks or drone stocks that had run up like crazy. They saw some sharp pullbacks. And sometimes, when the most speculative, risk-on parts of the market cool off a bit, it actually suggests that some of that excess froth is being worked out, which can make the foundation for the broader market a little bit stronger, a little healthier.
Okay, so technically, things look somewhat constructive or at least stable. But you warned earlier that this technical picture is kind of at odds with a more challenging long-term fundamental picture. And this is where we have to talk about valuations, right?
This is the crucial point, especially for anyone investing for the long haul, not just trading the next few weeks. The elephant in the room, really, is stretched valuations. Stock prices, particularly in the U.S., have just risen much faster than the underlying growth in corporate earnings, especially over the last year or so. And the metric we really need to look at here is the S&P 500's cyclically adjusted price-to-earnings ratio. It's
Oh,
often called the CAPE ratio, or the Shiller PE, after Professor Robert Shiller, who popularized it.
okay, so for listeners who might not be familiar, just briefly, what does the CP ratio measure?
Yeah.
And why is it sometimes seen as a better guide for long-term returns than the simple PE ratio we usually hear about?
Sure. So the standard PE ratio just looks at the current price divided by the last 12 months of earnings. But that can bounce around a lot based on short-term booms or busts in the economy.
Right.
The SAPI ratio tries to smooth out those cycles. It takes the current price and divides it by the average inflation-adjusted earnings over the past 10 years. So it gives you a much more stable picture of how expensive the market is relative to its long-term normalized profitability.
And where is that KPE ratio sitting right now? Because that's the worrying part.
It's approaching 40,
Hmm.
and historically, well, that's often described as rarefied air.
40. Yeah.
Readings above 30 are already considered very high, historically speaking. To give you some context, we've really only seen the KP ratio this high or higher maybe twice in modern U.S. history, right before the big crash in 1929, and right at the absolute peak of the dot-com bubble in late 1999, early 2000. Levels like this, historically, signal some pretty significant market fragility.
So what does history suggest happens next when the CP gets near 40? What should a long-term investor realistically expect in terms of future returns?
Well, history suggests a significantly lower outlook for stocks going forward. When the CP ratio has been this high in the past, the average forward return for the S&P 500 over the next 10 years has often been really disappointing, like low single digits, sometimes even negative after inflation, especially when you compare it to the returns you could get from safer assets like bonds at the time.
Mhm.
It basically signals that maybe all the good news, and possibly even more than the good news, has already been priced into the market. And that tension, that conflict between a market that feels strong in the short term because of technicals and liquidity, and a market that looks incredibly expensive based on long-term fundamentals, that's the core challenge for investors right now.
And that challenge is only made tougher by the global macro picture, which isn't exactly roaring either.
Precisely. We can't just ignore the backdrop. The IMF, the International Monetary Fund, they're projecting a slowdown in global growth. They see the risks mostly tilted to the downside because of trade tensions and geopolitical stuff.
Right.
And even here at home, domestically, while the stock market headline numbers might look strong, some of those alternative indicators we talked about, like regional sentiment surveys, some employment metrics, they are starting to point towards a cooling labor market and maybe some weakening in consumer sentiment as well. So yeah, the market might have technical support for now, but the long-term fundamental foundation, it definitely looks a bit wobbly. Which brings us squarely to the main event for the coming week. Because that earnings season, it's shifting from just a trickle of reports to a full-on deluge.
Yeah, the floodgates are opening.
And given that government data vacuum we keep talking about, these Q3 earnings reports, they're going to become the market's most important, most comprehensive real-time survey of the economy. We're finally moving from, noise and speculation to actual numbers from actual companies.
The shift in focus feels like it's going to be total. Investors are going to have to ditch the headline watching, the Fed guessing games, and really dig into the nitty-gritty, right? Profit margins, balance sheets, how much inventory companies are holding, and crucially, what they say in their forward guidance.
Exactly. What management teams say about the inflation they're seeing or the demand from their customers, that's going to be far more influential in the near term than any delayed government statistic we might eventually get.
Okay, so let's dive into the key areas. Where should we start? Maybe back with the banks, given last week's scare.
Let's do it. Financials are definitely under the microscope. And the immediate focus has to be on Zions Bank Corporation, Zion. They report Monday evening.
Right. After all the drama last week, you can bet every single word from their management on that earnings call will be dissected. What's the absolute key question Zion needs to answer?
They basically need to convince the market that this fraud issue was an isolated incident contained and dealt with. The key scrutiny will be on their commentary about their internal underwriting standards, their controls. Did they fix whatever allowed this to happen? They need to give specifics on that $50 million charge-off, and crucially, investors will be listening very closely for any hint of further stress, any other potential issues they've found in that C&I loan portfolio. If management sounds confident, says it's contained, the regional bank rally might continue. But if they sound hesitant, if they hedge, that credit scare could flare right back up again.
Okay, big test for Zion's Monday night. Then we pivot towards, maybe, the future of the economy, the AI litmus test. We've got some huge growth names reporting across the week. Let's start with Netflix, NFLX, Tuesday evening. What's the story there? Subscriber growth isn't the main thing anymore, is it?
No, not really. The consensus EPS estimate for Netflix is around $6.93, but you're right, the primary focus has really shifted. It's less about just adding new subscribers because that growth has naturally matured a bit. Now, it's all about how well they're monetizing those subscribers, especially through that new ad-supported tier they launched.
Right, the cheaper plan with commercials.
Exactly. And growth in ARPU, average revenue per user. Wall Street analysts are pretty bullish, actually, on the idea that advertising revenue can become a really significant high-margin growth driver for Netflix, maybe offsetting the slowdown in pure subscription growth. So we need to see strong evidence that the ad tier is actually scaling up and doing so profitably. That's the key narrative.
Got it. Then Wednesday evening, we get the big one, Tesla, TSLA. They've been cutting prices pretty aggressively around the world. How does that translate into the single most important metric investors need to watch?
For Tesla, given those price cuts, the number one thing to watch, the true barometer of their core business health right now, is automotive gross margin, excluding regulatory credits.
Okay, why exclude the credits?
Because the credits are kind of like free money they get for selling EVs. It doesn't reflect the underlying profitability of actually building and selling the cars. So taking those out gives you a clearer picture. And investors are really concerned that the price wars, especially the intense ones in China and Europe, have squeezed those core margins significantly.
What are analysts expecting for that number?
Consensus estimates are kind of hovering around 17.5% for that core auto gross margin. If it comes in substantially below that, that would be a big red flag. It would signal that the price cuts are hurting profitability more than they're helping stimulate demand, that demand elasticity isn't what they hoped.
And beyond just the margin number, what else does Tesla need to deliver on the call to keep investors happy, given its still very high valuation?
They absolutely have to deliver progress, or at least a compelling story, on the next wave of innovation. That means updates on full self-driving, FSD, where is it really going, any firm timeline or signs of accelerating the Cybertruck production ramp, and commentary on how they're using AI in their factories to boost efficiency. Without a strong narrative on those future growth drivers, the stock risks being treated more like just a regular car company, which would imply a much lower valuation.
Okay. And then for a really crucial read on how businesses are spending enterprise IT, the whole AI hardware boom,
Yeah.
we look to some of the older giants, right? IBM and Intel?
Exactly. IBM reports Wednesday evening, Intel is Thursday evening. Their commentary on data center demand is absolutely paramount. Data centers are the engine room for AI training, for large-scale cloud computing. So we need to know, are big corporations pausing their IT spending because they're worried about the macroeconomy, or are they actually accelerating spending, maybe shifting budgets to fund these big AI initiatives? IBM and Intel have a front-row seat to that.
And those U.S.-China chip restrictions must be hanging over them, especially Intel.
Huge potential headwind. Their management commentary on how the latest round of U.S. export restrictions on advanced chips to China is actually impacting their business, particularly for those high-end chips crucial for AI and data centers that will be a major factor in their Q4 guidance. Intel, especially, is seen as a bellwether for the entire corporate IT spending landscape. Their results often give a clearer picture of business investment than any single manufacturing survey can.
Okay, shifting gears again. Let's talk about the consumer. How resilient are they really? We get a consumer resilience gauge from some global staples giants like Coca-Cola,
Yeah.
KO, and Procter & Gamble. PG.
KO reports Tuesday morning, PG is Friday morning. And these two companies, because they sell everyday items globally, they provide one of the clearest, most immediate reads on consumer health. The key story here is volume versus price, meaning they've been raising prices quite a bit to combat inflation. Now, the question is that pricing power sustainable? Are consumers still paying up for Coke and Tide? Or are they starting to trade down, switching to cheaper store brands or private label alternatives?
Right.
So you need to watch their volume numbers. If volume growth is stalling or going negative, even if revenue looks okay because of price hikes, that's a signal of stress. It suggests consumers are getting squeezed, discretionary spending might be weakening, and retailers could end up with inventory problems down the line.
Makes sense. Okay, finally, let's check the pulse of the old school industrial and manufacturing economy. We get reports from GE Aerospace, GE, General Motors, GM, and Ford.
Yeah, these big industrial and auto companies give us that direct, unvarnished view on several key themes. First, supply chain normalization. Are things finally getting back to normal after years of disruption?
We hope so.
Second, labor costs. How are negotiations and wage pressures impacting their margins? And third, the massive capital-intensive transition to electric vehicles. How is that going? How much of it costing? And is the demand really there yet at scale? GM and Ford in particular will give us insight into whether demand for big-ticket items like cars and trucks is starting to soften now that interest rates are higher and maybe consumer sentiment is cooling off. Their results are also just a crucial barometer for overall global manufacturing health, which ties right back to those concerns we saw reflected in the soft oil price.
Okay, so we've got this deluge of earnings giving us the micro-level company-specific picture. But looming over all of that, you mentioned there are still two massive global macro risks on the calendar for next week. One is the health report card from China, and the other is that finally, hopefully, we get the delayed U.S. inflation data.
And they are timed almost perfectly to bookend the week, aren't they? It pretty much guarantees volatility right from the start through to the finish. Monday kicks off with a really critical global anchor, that comprehensive data dump from China.
And why is this one so important right now?
It's hugely important because it's really the first detailed, broad look we'll get at the actual impact of U.S. tariffs on their economy and just the general health of the world's second largest economy. It goes beyond just the monthly manufacturing PMI surveys.
So what specific numbers are coming out of China on Monday?
We get their Q3 GDP number. The consensus forecast is for growth to be around 4.8% year over year. That would be a bit of a dip from the 5.2% they reported in the previous quarter.
Okay.
We also get updates at the same time on their industrial production and their retail sales figures for September. Now, if these numbers miss the forecasts, especially GDP, you can expect a wave of global growth pessimism to wash over markets pretty quickly. It would likely dampen commodity prices, hurt risk appetite across the board. Oh, and also on Monday, the People's Bank of China, the PBOC, they announced their loan prime rate decision. The consensus there is that they'll probably hold steady at 3.00%, but any surprise cut could also move markets.
Okay, so China sets the tone early, and then all week long, we digest earnings. But the ultimate decider, the real arbiter, arrives on Friday. That delayed U.S. CPI report, the inflation cliffhanger, as you called it. The market's been holding its breath for this one.
It really has. The significance of this release, you can't overstate it. It's very high. After 2 full weeks where the market has been trading based on assumptions, based on hopes about what the Fed might do, this September U.S. Consumer Price Index report is the single most important piece of data. It will either validate or completely shatter that dovish Fed narrative that's been underpinning equity valuations.
So what are the consensus forecasts actually looking for in the CPI numbers, and what's driving those expectations?
Okay, so the consensus forecast for the main number, the headline CPI year over year, is 3.1%. That would actually be a slight tick up from the 2.9% reading we got for August.
An increase. Why?
It's mostly expected to be driven by still sticky shelter cost, rent, and housing, and also persistent inflation in services. But crucially, the core CPI number, that's the one that strips out the volatile food and energy prices, and it's the one the Fed pays most attention to.
Right.
That one is expected to hold steady at 3.1% year over year, same as the previous month.
Okay, so the market reaction here feels almost binary, doesn't it? It's either good news for the bulls or really bad news. How do you see the market responding to either outcome.
I think it really is that binary. If the numbers come in soft or even just exactly in line with that consensus, so 3.1% or maybe even a touch low way, the market will likely read that as a green light for rate cuts. It confirms the bullish assumption that inflation is basically under control, heading the right way. That could easily spark a significant rally in both stocks and bonds. But the flip side, if we get a hotter than expected number, let's say headline or core comes in at 3.3% or higher, well, that directly challenges Chair Powell's recent dovish leanings. It completely undermines the rate cuts are coming soon narrative. And that risks forcing the market into a rapid, sharp sell-off as those policy expectations get instantly repriced. People would suddenly have to consider rates staying higher for longer, or maybe even another hike down the road. Big potential impact.
Wow, okay. So huge stakes riding on that Friday CPI print. And beyond those two giants, China GDP and US CPI, there's other important global data sprinkled through the week too, right?
Yeah, it's not just those two. We also get the UK's CPI inflation reading on Wednesday, which is important for the Bank of England. And then on Friday, alongside the US CPI, we also get the flash manufacturing PMI surveys for both the Eurozone and the US. Those give a very timely snapshot of economic momentum in the factory sector. So yeah, after weeks of waiting, the data calendar is finally packed again.
So, okay, let's try to tie this all together. What does this all mean for you, the listener?
Basically, the week ahead marks this really critical inflection point. The whole market narrative is pivoting away from just reacting to speculative headlines and geopolitical noise and shifting towards a much more grounded assessment based on actual corporate fundamentals coming out of earnings season. Now, we do have those short-term technical signals we discussed, the VIX calming down, the S&P holding its 50-day average, that suggest maybe a moderately bullish bias for now.
Right, the technicals look okay.
But, and it's a big but, that technical strength is really tempered by some significant underlying risks. We just cannot ignore how stretched valuations look, especially that SAPE ratio getting close to 40. That's a major long-term headwind. And then there's the huge event risk hanging over Friday with that delayed CPI report. So overall, the environment still seems to demand a pretty cautious, selective, and fundamentally driven approach right now. Prudence seems warranted.
Absolutely. It feels like the market's direction, certainly over the next few weeks, maybe longer, really hinges on this one big question. Can this flood of Q3 earnings reports the actual profit margins, the guidance from companies, can it somehow validate the optimistic story that's pushed stocks up so high, despite all the macro worries and the geopolitical uncertainty? We're basically looking for the fundamentals to justify the price action we've seen.
That's the entire story we're going to be watching unfold day by day next week.
So maybe a final thought for you, the listener, to chew on as you watch these numbers roll in next week. Keep a really close eye out for a potential bifurcation in the results.
Bifurcation, meaning?
Meaning, watch for a significant split, a divergence. Maybe you see the AI-focused story stocks, think Netflix, think Tesla. Maybe they post strong narrative-confirming results, perhaps justifying their huge valuations in the eyes of bulls.
Okay.
But at the same time, maybe the real economy, bellwethers, your Coca-Colas, your General Motors, your IBMs, maybe they come out and guide for noticeably weaker demand or talk about ongoing margin pressure from labor costs or input prices.
I see. A split between the hype and the reality on the ground.
Exactly. If that kind of divergence really shows up clearly, it would tend to confirm that the market strength is still highly concentrated in just a handful of mostly speculative high-growth names. And if the strength is that narrow, it makes the advance for the broader market seem much less sustainable, much more fragile. That concentration risk, I think, is the key fundamental hurdle for the market as we head towards the end of the year, almost regardless of what the Fed says or does next.
That's a great point. A highly concentrated market is often a fragile one. Understanding where that divergence lies, if it lies, that will probably be the most valuable piece of insight we gain next week. Well, thanks for joining us for this deep dive. It's going to be a busy one.
It certainly is. We will be back next week, of course, to break down everything that actually happened. We'll see you then.